My entire career actually started while I was doing a little bit of residential, but quickly learned that that was not the space for me. I was more excited about selling returns and cash flow. I chose multifamily because for me, it was the easiest to understand. I had been a tenant before. Started cold calling on 4 units, and 4 units turns into 8 units, turns into 16. Here we are now. I'm over at an average deal size ranges from 5 to 30 million.
Let's talk about what you're seeing right now, because things have really changed these last couple of years. There's a lot of distress. Some competitors of mine are calling it the multifamily meltdown. Give me your take.
Yeah, I think we've seen, number one,
Welcome to another edition of Lifetime Cash Flow Through Real Estate Investing. I'm Rod Cleef, and I'm thrilled you're here. And I know you're going to get tremendous value from the gentleman I'm interviewing today. His name's Luke McCann, and Luke's a VP of the Multifamily Investment Division at NAI Global, and leads the firm's mid-market and development brokerage in the Jacksonville area. So we're going to have a lot of fun today. Welcome, brother.
Yeah, excited to be here. Thanks, Rod.
Okay. So, did you drive over today?
I did, yeah. So it's actually
that's
been
a 5-hour drive. Huh?
Well, I've done a big loop around Florida this week. So started down in Miami for a conference, drove over here yesterday, had a couple meetings in the Tampa area.
Okay. All right. So not so bad. You didn't look like you were too exhausted. Okay, good. Well, why don't you take a minute and, give us some of your background?
Yeah, sure. So based in the Jacksonville area, like you said, we tackle the middle market multifamily space, which is really just call it 50 to 300 units or so. Mm-hmm. Really focused exclusively on the Jacksonville MSA.
Mm-hmm.
So really,
and by the way, guys, MSA means Metropolitan Statistical Area.
Exactly.
Okay.
Yeah. Mm-hmm. So, been in Jacksonville my whole life, born and raised there. Come from a family of investors. I've always believed in real estate as a wealth vehicle, and knew I wanted to get into that space. Been on the brokerage side really my entire career. Actually started while I was still in college doing a little bit of residential, but quickly learned that that was not the space for me. I was more excited about selling returns and cash flow rather than drapes and countertops and colors.
Well, you have a finance degree, so that ties in, right?
Yeah. So quickly learned that the investment space was more the space for me. So, chose multifamily because for me, it was the easiest to understand. I had been a tenant before. I had seen how these things operate. Mm-hmm. And just kind of went from the ground up, started cold calling on 4 unit properties.
That's what you guys have to do, right?
Yeah, exactly.
You beat the phones.
Right. And 4 units turns into 8 units, turns into 16. And here we are now. I'm over at NAI, and average deal size ranges from 5 to 30 million, I'd say.
Yeah. Nice. So I love the Jacksonville market. As I was telling you before we started recording, I know we put an LOI in on one asset there, didn't get it, but absolutely. Well, candidly, I love Florida, period.
Yeah.
I mean, you can't keep people away right now. Let's talk about what you're seeing right now, because things have really changed these last couple of years, and there's a lot of distress. Some competitors of mine are calling it the multifamily meltdown. I mean, I'm seeing the pain. I'm even experiencing some pain, and so there's a lot going on right now. What? Give me your take.
Yeah, I think we've seen, number one, a migration from floating rate to fixed rate debt, just as interest rates have shot up here. And that reverberates throughout the market in many ways and makes it very challenging, not just from a valuation perspective, but we've seen a lot of owners in our markets where their debt service has tripled, if not quadrupled, in a very short period of time. And it becomes pretty challenging to operate properties in an efficient manner when that happens. Underlying all of this is, as well, though, is just supply and demand have completely been turned over.
Yeah.
The demand is still pretty robust, really across Florida and even the Sun Belt. Mm-hmm. Our job numbers remain strong. Mm-hmm. Our population growth remains very strong. It's just an even staggering amount of supply coming online. So, for example, in Jacksonville, we historically deliver about 3,000 units a year. That ticked up post-COVID. We're going to do just under 8,000 this year. So over 2 times our historical average. And so when that happens, naturally, you're going to see occupancy soften. You're going to see rent soften. The good news is in the multifamily space, supply is one of the easier things to project, because once you put a shovel in the dirt, it's 2 to 3 years before you're going to deliver the building in full. And
Let me stop you for 1 second.
Sure.
Have you seen that slow down?
100%. Yeah.
So that I just wanted to hear them to hear it.
Yeah, exactly. So starts are down massively,
Right.
really across the country.
Right.
And so in Jacksonville, again, we're going to go from just under 8,000 units this year in 2024 to next year about 2,500.
Wow.
So the writing's on the wall. Supply and demand are coming back into balance here.
Mm-hmm.
Think we're still adjusting to a new normal in terms of capital markets, interest rates, and it's more challenging to raise equity right now.
Much more challenging
than it has been. So, but I think the good news is the fundamentals are coming back much more into favor here imminently.
So let me ask you this question. It's not the greatest time to sell with cap rates where they are, yes?
Sure.
And I've heard, I don't know what the actual numbers are, but I heard sales are down as much as 85, 80, 90% right now.
That's it. Yeah.
Okay. So would it be an accurate statement to say if someone is selling right now, they pretty much need to sell?
There's definitely a need. Yeah. I think if you're
It's
selling
more than want, it's need at this point.
And it's in large part a debt-driven decision.
Mm-hmm.
So you're past your maturity, or you can't fund a rate cap, or you're just frankly out of money.
Yeah.
So there's a lot of that happening, and those are never easy.
Right.
It takes a little bit of pain, I think, for that kind of opportunity to meet market pricing, so to speak.
Right.
There's always going to be, long-term owners that may have bought their deal 10, 15, 20 years
they're
ago.
not in trouble, right?
Yeah, there's always going to be a little of that sprinkled in every kind of market. But right now, the theme is certainly distress.
Right. You've heard the catchphrases "survive till 25,"
Indeed.
And the lender phrase "extend and pretend."
Yep.
And we're seeing lenders work with borrowers as much as possible, because the minute they foreclose, it hits their balance sheet.
Right.
Or actually the minute they default, it does. So these last few years, Fannie Mae and Freddie Mac dropped their loan to value. They're not stupid. They've been around a long time, and a lot of operators use bridge debt.
Yep.
And I think I would say definitely some, maybe many cases, they use bridge debt because they got higher loan to value and were able to show higher returns.
Yep.
You think that's an accurate statement?
100%.
100%. Okay. So, and just describe bridge debt, if you would, for my listeners.
It swept the market really from 2020 into early 2023. You got super high leverage. There were some deals that by the time you factored in the lending that was happening just for the CapEx budget, forget about the acquisition.
Right.
Some of these shook out to be 100% loan to value.
No kidding.
Yeah.
We're going to take a break from this great episode for a word from our sponsor, which is the Multifamily Bootcamp. Now, financial success is what you're after. We are rapidly approaching one of the greatest opportunities I think we're going to see in our lifetimes to capitalize financially. So if you know real estate is the vehicle for you, you're crazy not to spend a couple days with me at one of my boot camps. I've always got one right around the corner. Thousands and thousands of people have taken action on their journeys to creating generational cash flow for themselves and their families from attending my events. I don't sell anything at this event, so it's basically 16 to 18 hours of training with nothing being sold. Kind of a no-brainer if you're serious about this. To check it out, text the word links to 72345 or go to rodslinks.com. Again, text links to 72345 or go to rodslinks.com. I promise you'll be glad you came. Let's get back to it.
Yeah.
Holy cow. By the way, CapEx, guys, is the money you put into a deal to really add value, increase rents, things like that. It's capital expenditures. For those of you, I know for some of you, like, okay, come on, let's keep going here. But for some of you, don't know what it is. Okay.
So, I'll take you back to 2020, 2021. You could pull a floating rate bridge loan out at 4% interest and get 80% loan to cost. That was pretty easily obtainable.
Right.
And if you're in that market, and we have clients that just said, "Hey, I refuse to pull bridge debt out in this climate," and they just weren't competitive. If you're pulling agency debt out at 65% and you're competing with another buyer that's getting,
80%,
exactly, at frankly a not too dissimilar interest rate at that time,
right?
Almost all of the transactions that we saw in that time frame went bridge.
And see, guys, the reason that is that the reason that loan to value is relevant is because the less equity in a deal, the higher the returns. Okay. And so typically, and And equity is basically the down payment, closing costs, operating reserves, CapEx budget, things like that. Money out of pocket, not in the capital stack. It's not the debt. It's the money that you're raising out of pockets plural, to put into these deals. And the less of that you have, typically the higher returns you can project. Yes?
Exactly.
And so, if you are trying to get that conforming Fannie Mae and Freddie Mac debt at the similar interest rates, you can't compete with these guys that are coming in using bridge debt,
right.
and you're not getting any deals.
Right.
And so everybody's doing bridge debt.
Sure. Now, over the course of 2022 to now, obviously interest rates have come up significantly.
Right.
And so that same borrower that was pulling an 80% loan to value at a 4.5% interest rate, that interest rate now has gone to, it peaked at, 9.5%, 10%.
Yep.
All the while, expenses started to outpace income growth.
That's right.
And the properties just start to deteriorate. We saw a lot of groups come in that frankly just didn't budget to have any working capital.
Wow.
And so when all of a sudden your debt service starts to swell, you have to allocate more capital to servicing that.
Right.
All of a sudden you can't fix the toilet as quick. The
Right.
unit stays vacant a little bit longer, and it can snowball there. We saw.
Oh, it's a death spiral.
No doubt.
I've seen it time and time again. What are the payments they require to get ahead of this? What do they call those?
Interest reserves.
Interest rate. Yeah.
Yeah.
So a lot of times lenders will require interest reserve payments. And I remember looking at an asset, I think I've said this several times, but in San Antonio, the guy's reserve payment was $8,000 a month, and it went to $80,000 a month.
Mm-hmm.
And how do you do that?
Yeah.
And if you got interest rate at 3-4%, it goes to 10. How the hell do you do
Right.
that? You can't make that work in any way, shape, or form. And what lenders are doing right now, what I'm seeing for the most part, is they're just doing deferrals, where they defer. They'll drop the interest rate temporarily to allow an asset to survive, but they're kicking that on the back end.
Sure.
Let me ask you this. Do you think that's a viable solution, or do you think that's going to create even bigger debacle in the future?
Yeah, I think that road will end. I think that's a key theme as we go into 2025 is, to your point, there are some built-in extension options to a lot of these bridge loans,
Right.
but usually those are tied to specific property performance metrics,
Right.
that
Which
frankly
aren't being met.
Exactly. But what we've seen is that these lenders still are willing to extend because, especially as it relates to Florida, the alternative is, okay, lender's going to take the property back. Well, the foreclosure process in Florida is not an easy one. It's lengthy, it's cumbersome. And all the while, the property is going to continue to deteriorate throughout that process. And so we've seen these lenders, extend and pretend is very much real.
Right.
The fact of the matter is these bridge lenders, AKA debt funds, they borrowed their money as well. And they borrowed their money on, let's call it 5-year paper. They just gave out bridge loans on 2 to 3 year terms. And 5 years from 2020, when we saw this bridge craze start to begin, is next year. And so I think a big theme over the next 12 to 18 months is these bridge lenders are now going to have to start writing these loans on their balance sheet down to what they're really worth, and they're going to have to clean up their balance sheet with that. That's what I think is going to start to push transaction activity back to where we all want it to, and close that bid-ask spread.
That's one way to describe it. It could also create an absolute shit show in the market.
Sure.
If they're foreclosing on all these assets, there'll be a lot of fear. Fear will be pervasive. It'll be interesting to see if all these players on the sidelines will still be there, or if the fear will cause them to put pencils down.
Regardless, it creates an opportunity for new capital.
I agree completely.
And that's
I agree
market
with
cycles.
That.
Right?
I agree with that completely. We're actually putting a distressed asset fund together ourselves right now. I'm involved in some deals that will likely be recapitalized, bringing in operators to put in money and assume debt and recapitalize some of these assets. And I think there's some real opportunity there as well.
Definitely, yeah. We've actually been involved on a few of those in Jacksonville. Yeah, where it's very much relationship driven. These lenders are not out here advertising their distressed deals,
right?
Because frankly, they're oftentimes not worth what the loan balance is,
right?
And so we have seen the groups that are willing to kind of roll their sleeves up, get creative, work hard to kind of build these relationships up with these bridge lenders to step in, say, okay, I'll bring some fresh capital into the deal. We'll get it stabilized, and here's a clear path to an exit.
Right, and they'll have to do some
doubt.
They'll have to do some modification for sure.
And what's helping that is we are starting to see interest rates come down.
Yeah.
And I think that's what everybody has been hoping for, is that come 2025, 2026, interest rates will be lower, supply and demand will be back into balance. It's really challenging right now in some of these Sunbelt markets where there's a lot of oversupply. It's really challenging to.
Yeah, I'm in Texas, and we've seen a lot of distress there. A lot of distress in markets that just looked fantastic 2 years ago.
Sure.
So it's very frustrating. So I speaking about the election results and Trump in office, and Trump obviously is a very sophisticated real estate investor. Do you believe, I mean, just opinion, this is all opinion here. Do you believe that he'll be effective in getting the interest rates down and making some moves to help our marketplace, the multifamily marketplace?
Yeah, I'll tell you, in the days following the election, it seemed like every phone call there was investor optimism. So that was very much welcomed. Treasury markets have been still volatile since then.
Yeah,
so,
I've seen the 10-year, it's actually climbing.
Yeah.
I had a conversation with one of my partners yesterday. He thinks it's Bitcoin related, that a lot of money's flowing into Bitcoin. I thought that was interesting.
Yeah. So I think we still expect interest rates to come down, at least the federal funds rate, which is what we're all talking about when it relates to interest rate cuts. Treasury markets, I think until we have a real solid grip on what policies actually are going to get traction and get put into place, I think we'll continue to see elevated volatility.
No, that was a great way to describe it. Which policies actually get traction?
Yeah.
It was like this whole immigration thing. I mean,
right.
I don't know about the logistics and or viability of what was promised in the election. So,
and we've seen this before, right?
It's
one thing to campaign on something; it's another thing to actually get it through all the layers, of our government.
Well, I think that piece is handled because he's got the House and the Senate, right? So I think the layer piece might be less cumbersome than it's been in the past, but the actual execution is what I'm wondering if he's able to. Well, that's part of the execution too. So
definitely. So I think the onshoring of jobs is only going to help, right? I think just general investor bullish sentiment helps as well. We've seen. It feels like we're going on year 3 now of people sitting on the sidelines waiting for the right opportunity. I can remember, beginning of 2023, the theme was, all right, we're looking for the distress. The distress opportunities have not come available as much as we all would have wanted.
Because they're kicking the can down the curb. These lenders are,
exactly.
So they're giving these operators a glimmer of hope.
Right. So look, a lot going on.
It is a crazy time to be alive in our business.
No doubt.
So let's shift gears for a minute. Let's talk about how wannabe operators or existing operators create good relationships with people like yourself, with brokers in the commercial real estate space. Yeah. It was very difficult to even bend a broker's ear back in the day when things were flying left and right, and and deals were trading like crazy. But give my listeners some advice for communicating with someone like yourself, how to best do that, how to not be a pain in the ass, so speak to that a little bit if you would.
Yeah, for sure. I think, look, a large part of our day-to-day as brokers now has shifted into developing new relationships, because the same people that were buying deals 2, 3, 4 years ago are not the same groups that are buying deals today.
Right.
And so a big part of our effort is expanding our outreach, building new relationships with new equity. And so look, we're here to talk, I think.
Well, that's why you're here today.
Yeah, exactly. We want to reach folks. If you're interested in looking at deals in the North Florida area, we like to think that we know the big macro themes to get you a little bit more educated and comfortable on the market if it's new for you. Or, from a micro perspective, if you've got a deal, hey, this is the right street corner, this is the wrong one. But that constant communication, I think, is important. I'll tell you.
So when someone is coming to meet you, you like that consistent communication, yes?
For sure, especially if you're trying to get your hands on deals, because over the past 2 years, a greater proportion of our deal pipeline has pivoted to an off-market basis. And that's for a number of reasons. But I think the relevant theme there is that it's not as simple as sending out an e-blast now and having everybody come to you.
Right.
And we're having to pivot our efforts to a much more targeted one-on-one approach. And the more I'm talking with a buyer or a client, the more that they're going to be top of mind. So when I do find that off-market deal that meets their criteria, boom, it comes to mind.
Oh, that makes good sense. And I mean, obviously this is a personal question, but is there a preferred mode of communication? I mean, is it emails? Is it phone calls? Is it all the above? I mean, just curious.
Yeah, I think that's probably a little bit broker to broker. For me, I'm not too particular.
Okay.
I'll tell you, the more touch points that we have, I'll speak for our team. We keep track of every
communication.
Every forum, and we track the stats of kind of the meat and potatoes of our business, which are CAs, confidentiality agreements. So when we have a new deal, we create a deal room for it that houses the financials. We'll send you a link, you execute a CA, and boom, that goes into our system.
Right.
So any given buyer.
Hang on one second. So guys, a confidential. What do you call it?
Confidentiality agreement.
Confidentiality agreement is standard in the industry. I sometimes get people call me and say, "Hey, they want me to sign this thing. What's that about?" And you're going to do that almost every time. Just so you know, that's how you get the financial information on a deal. Okay, Please continue. Sorry.
Yeah, no problem. Okay. So we're tracking all that. So if you're a buyer and you've executed CAs with us, we could tell you every deal that you've done that for. And if you aggregate that information, you probably can back into, okay, what is their preferred asset type, size, age, location.
So they don't send you their criteria?
They do. And that's something we've definitely tried to keep track of.
Right.
Frankly, for us, because we're aggregating the CA information, if we get a new deal in the pipeline and let's say it's an off-market deal, I'm going to go to the deal that we sold last year down the street that was similar size and similar age. Gotcha. And that's where I'm going to start to build out my buyer list.
Gotcha.
I would say even more important than that, we're tracking every offer that comes in as well. And we have a master offer tracker for every given deal. And so again, we get a new deal in the pipeline. We say, okay, what's a similar deal in the recent past that we've worked on? Who offered on that? We're going to go there first. Even if you're not competitive, I still encourage putting offers in writing.
I'm so glad you said that. Because I was just going to ask you that question.
Yeah.
In today's market, I think it would be crazy not to make offers on anything you have an interest in.
100%.
Yeah, because, right now, would you say the most important factor is surety of close?
Definitely.
Yeah.
Definitely.
And so, what we mean by that, guys, is it's more important than the price. The surety of close is the deal actually going to close? And so, if there's a way to show that based on performance, based on having money go hard, non-refundable, things of that nature, limited or no contingencies, which is in the financing world, to me, a little sketchy right now to not have a financing contingency. Are you seeing deals without financing contingencies with people that are getting financing?
So I would say it's typical. The smaller the deal, the more likely that there's a financing contingency.
The smaller the deal.
Yeah,
okay.
But I think that just goes down to the buyer.
Okay.
But to your point with financing being shaky right now, that's even more that puts the incumbent on us as brokers to go do the diligence on the buyer, because at the end of the day, what the seller wants is when we go through an offer process and we present the offers to them, they're going to come to us and say, okay, who do you think's got the best
chance of closing?
Exactly.
Right.
And so that's what the LOI reads in terms of not just price, but terms, timing, deposits, et cetera. But it's also, what's your background? Tell me about your equity source. Tell me about your underwriting. What are you assuming for insurance? What are you assuming for taxes?
Right.
These are all things that, A, we like to provide the answers up front for to shorten the learning curve for that buyer. But B, if your assumptions are way off, that can be a red flag.
Well, sure. No, it is a red flag for sure.
Yeah, no doubt.
By the way, guys, LOI means letter of intent. And I know some of you guys, come on, get on with this. Well, some people don't know what a letter of intent is. And basically, when you do one of these deals, you have a purchase and sale agreement. And you never, ever, ever, ever not have legal involved, have an attorney involved when you do a purchase and sale agreement. And attorneys aren't free. So you start with what's called a letter of intent, and that lays out the main terms of a deal, the price, the due diligence, the timelines, the financing, and all the major points or any unusual points. And if the seller and buyer sign that, then they send it to legal to fight out the purchase and sale agreement. So that's what a letter of intent is. Anyway.
Right.
So, okay. And so, in my view, it's been hard to find deals just because these lenders have been kicking the can down the curb and distressed deals, that is. I personally believe that's going to change. We'll see. I'm wrong all the time. But what are some other value propositions that you can offer a prospective buyer? We talked about that briefly before we started recording.
Definitely, yeah. So we are data junkies, especially in the real estate space, where I think we found relying on the traditional sources like CoStar, like Real Capital Analytics. They're good, I think, at tracking the macro trends. But when it comes to micro of markets and fundamentals, rent growth, occupancy, new supply, we found that there's a lot of misinformation spread around there. For example, the supply pipeline. You could have a developer announce big plans for a new project. We're building 300 units here. Well, until they pull their construction loan or file a notice of commencement.
Or raise the money they need to do it.
Exactly.
I mean, I've got a buddy that's got 9,000 doors in Texas, and he's got projects he can't get out of the ground that he's trying to build right now.
Right.
So I'm sorry.
Yeah. We saw an article from one of those publications here recently that said Jacksonville is absorbing 14,000 new apartment units in the next year. Wow. And so our clients reach out to us and say, hey, what the heck? That's a staggering number. Well, we actually track all of these deals. We're driving them. We're looking at the public records to see what's actually happening. That number is actually closer to half that.
Right.
So we are constantly putting out good data. Our quarterly market reports, which have details on the fundamentals, it's the first thing we send to a new prospective buyer that says, hey, I'm new to Jacksonville. I want to learn more about it. This report's going to have the fundamentals broken down by submarket, supply pipeline, historicals, job data, population growth, et cetera.
How do they get a hold of you?
Readily available on
email out
on
there
LinkedIn.
LinkedIn.
Yeah,
so it's Luke McCann, McCann.
Right, exactly. Okay. Email to it's lm@naihallmark.com, or just go to our website, naihallmark.com, and you'll see my contact info.
I thought it was NAI Global. Okay. Did they change the name? Or
no, Global. That's right. So Hallmark is the Jacksonville branch of
gotcha.
that.
Okay.
But frankly, there's only a handful of multifamily dedicated teams in the entire global branch.
Okay, gotcha. Okay. I learned something today.
I will say as well, kind of going back to more and more of our deal flow pivoting to an off-market basis. It's rare that our deals hit some of the more traditional online platforms that you'd see, like Crexi or LoopNet.
Right.
We really market exclusively to
your list,
our own list, right? So if you're interested in seeing deal flow from us in Jacksonville, reach out. We want to get your email on our distribution list. We want to know your acquisition criteria. That way you'll see everything from us.
Yeah, you'll get the research that you provide.
Exactly,
All the big houses provide research, and that's a great source of information. And then you'll be on their short list for deals.
Exactly.
Yeah, right?
Yeah.
So talk about referrals, because in our business, it used to be that you'd Google something, hey, I need something, I'll Google it, or it used to be the Yellow Pages. That's how old I am. But that's really not how this business is done. So describe how you find the best resources in our business.
Yeah, for sure. I think we take a lot of pride in that because, again, we like to provide all the answers up front for any given deal that we have. So when we take a new deal out, we're going to have it accompanied by an insurance quote. We're going to have a debt quote. We're going to send you to debt and insurance brokers that we've executed with in the past, and we know that they're highly reputable and not going to change terms on you at the last minute.
Right.
And even the micro things, like we have a preferred vendor list. So things as small as
painters, plumbers, electricians, drywallers, roofers, all of that, right?
Because there's so many of them. And if you did a Google search for plumbers in Jacksonville, you're going to see 30 come up.
Right.
But these are all vendors that we vetted out. Either we have relationships with them or they've come highly recommended from other clients.
Right.
And so again, if you're new to Jacksonville, we want to have all those answers to you, and we've got that data assembled, and we're always happy to share it.
No, that's fantastic. That's really how this business works. So the next thing I want to ask you, that I ask anytime I interview or speak to someone that's a broker or a real estate agent, is why the hell aren't you buying your own stuff? Okay, so let's talk about that a little bit, please.
Yeah. So look, it's the reason why I got into this business. Like I said at the start, I believe in real estate as a wealth vehicle.
Are they golden handcuffs or what's going on here?
Well, as time has gone on, I have invested in some deals just passively as an LP, but the plan is always to build out your own portfolio.
Right.
And what I found is, you'd think being in the real estate profession that deals may just fall into your lap, or it's easier to just kind of overlap the personal with the brokerage side. That's not the case. It's just like any other profession, whether you're in the medical space or you're in finance or accounting or whatever it is. You need to be intentional about that. You need to set aside time. You need to be looking at deals. You need to have a process down, because again, they're not just going to fall into your lap. You need to have a plan. And so it's definitely something that's
on the horizon for you.
Definitely. And it's an everyday thing, too, to be intentional about taking the broker hat off and putting the principal hat on. And so, I think it takes some intent, it takes some dedicated attention, and it takes a plan, just like anything else.
It takes hunger.
Yeah, exactly.
You got to want it.
Sure.
You got to want it to be able to push through fear, to be able to push through any limiting beliefs that you have. When I just had a boot camp last weekend, had 800 plus people there, and the first thing we do is goal setting on steroids, because you've got to have that. You got to build what Napoleon Hill in his book Think and Grow Rich calls a burning desire. You got to want it to actually take that and carve out time at night. And I'm not speaking about you directly, but to get off freaking Netflix, to get off screwing around, and actually, like you said, be intentional. To grind for a few years like most people won't, to live the rest of your life like most people can't. Right.
Yeah. I think the time is going to grow to fill the space that you give it in terms of your career. So you need to carve out some time to be intentional about achieving your goals. And it's not just real estate, right? It's anything. It's health, it's relationships.
Oh yeah. Personally, that's right. Yeah. It's all of that, health, relationship, all of that. Yeah. I've got a lot of aspiring multifamily investors that listen to my show. I'm blessed to say it's the largest in the world for what we do, which is just blows my mind whenever I think about it. But they're listening. They have a job. Maybe they're comfortable, but they know they want more. Speak to them. What would you tell them about moving forward?
Yeah, for sure. And I'll start by saying, we've had the fortune of working with many of your students that are active in Jacksonville and elsewhere.
No kidding. Wow.
Yeah. So
that's could.
Yeah, definitely. It's a huge community, and it's great to see that success.
Thank you.
So, for aspiring investors, again, I think it starts with getting educated, which obviously you do a great job of. I think as brokers, we're here to help get you educated on the market and all the things that we've been talking about, from a micro deal perspective to what relationships you need to have on the operational side. And again, lean on us as brokers to provide those answers. I think that's a big part of our job. I think keep swinging, keep underwriting deals. I think the more you underwrite deals, the more you practice, even if they're not working, you're intuitively going to start to get a handle on what rents are in this area or what they should be. Yeah. You're going to get a handle on what things are trading for in terms of price, cap rates, et cetera. The best way to dive into a market is just by underwriting deals. You can read all the literature you want, but at the end of the day, we're here to buy and operate and execute on deals. And the best way to kind of shorten that learning curve and immerse yourself into a market is by underwriting everything that comes into your inbox.
By the way, if you come to one of my boot camps, you get our deal evaluator software, which is absolutely kick ass to do this. Okay. And it was developed by someone on my team, and it is really good. So, you're able to start doing that, which you need to do. That's the bottom line is repetition is the mother of skill. And the more you review things and look at it, you'll get to where you can smell if a deal's a deal, very quickly, and get rid of the crap that you don't want to waste any time on. You agree with that?
Right. Yeah, 100%. and it's not as easy as throwing a cap rate on an NOI.
No.
I have a hard time sometimes with buyers that are just solving for a cap rate because frankly, that just doesn't paint this.
That's one little piece of the puzzle.
Exactly. Yeah.
You've got to normalize the expenses. You've got to normalize the income. You've got to project the expenses and the income. You've got to actually look at comps, and see what you can realistically expect in rent. You've got to look at the median income to make sure that income will support what you think the rent will be.
Sure.
All of these things.
And we as brokers, I can tell you, us in particular, again, we try and provide that up front. So we'll take market expenses and build it out. In a pro forma on the income side, we take a three-pronged approach to building out our rent profile. It's one, what rents have been achieved on the property today. Two, what is the income in the area support for those rents? And three, what do the comps say?
Yeah, real comps.
Yeah, right. Real comps,
like comps that are actually comparable.
Sure,
yeah,
sure.
Yeah. So, and guys, there are a lot of reputable brokers out there like Luke, but you always do your own homework as well. Would you agree with that?
Yeah, 100%.
You do your own homework as well, and really dig in. And the more you do that, the better you're going to become. Well, brother, I really appreciate you coming on the show. It's been a lot of fun, and let's plan to have you come back in a year or so, and let's see where we are there. That'll really be interesting.
Sounds like a plan.
And we'll have to circle back to this and just see what happened in this year that's coming, because it's going to be crazy.
It's exciting. Yeah, looking forward to it.
All right, brother. Good to see you.